markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
We've got fewer than 43 minutes until the closing bell. The equity market is tumbling today on the bet for more aggressive Fed tightening. Let's get you the latest on the price action. Bill Maloney is with us from the Macro Squawk Desk. Hey, Bill.
And good afternoon, Doug. U.S. stocks are plunging today as the 10-year yield hits the highest level since 2011. Dow's currently down 780 points. S&P's drop 134, and NASDAQ is lower by 4.2%. That U.S. 10-year yield at 3.37%. Gold is down 47 points. Oil is in the red, and Bitcoin is down by a whopping 15%. Among the main 11 S&P sectors, all were in the red, led by declines in consumer discretionary. Leaders to the upside in the Dow, only McDonald's and Cisco, while Boeing fell 10% and led to the downside. In deal news, Prologis to buy Duke Realty in a $26 billion all-stock transaction. And wrapping things up, Oracle reports after the bell. Live from the First Breaking News Desk, I'm Bill Maloney. Doug?
All right, so I think it's fair to say that a half-point rate hike is baked into the equation, although some on the street are expecting a move of 75 basis points. And the Wall Street Journal is saying now that Fed officials could approve a 75 basis point hike in the Fed funds rate. I'm Doug Krisner, and that is your Bloomberg Business Flash.
God, 50-50? Do I hear 75-75? Do I hear what? It's just like unremarkable. I know. All right. It is, though, top of mind, rightfully so this week. The FOMC, the policy-setting arm of the U.S. Federal Reserve, meeting this week with a decision out on Wednesday, and talk about being between a rock and a hard place, which is exactly where Fed Chief Jay Powell is, right, Tim? Because he's got to really choose between elevated U.S. inflation and a recession. I mean, that's what it comes down to at this point.
And what we learned on Friday is that inflation had not peaked in March like many had thought. Rich Miller is economics reporter for Bloomberg News. He joins us on the phone from our Washington, D.C. bureau. He's got a great article out, among the most read, about Powell facing this choice between elevated U.S. inflation and a recession. Okay, we understand the rock and the hard place that Powell is at, Rich, right now. How do we have to look at his ability to actually use the blunt tools of the Fed and do what somebody he said he's looked up to, Paul Volcker, did years ago, and raise rates to just shock the system and bring the U.S. into a recession to bring down this inflation?
Yeah, I mean that's the problem. I mean, Volcker is lionized for bringing down inflation. The thing that people forget, or in that, is that he put the economy through the ringer to do that, and we had to get unemployment over 10%. So some people in the market are saying this is Volcker's moment, or this is Powell's Volcker moment, when he's going to have to decide. Am I willing to put the economy through pain to get this inflation down? So far, he's kind of shied away from saying that. He's saying there's going to be some pain. Unemployment may go up a bit, but if you look at the so-called dot plot, it seems like it's like sort of an immaculate reduction in inflation without unemployment going up. And more people are saying that's not realistic. And we'll see what happens tomorrow.
Rich,
Wednesday.
No, I know, right? Feels like it should be Wednesday already,
right.
To be quite honest.
What a week it's been.
I know, exactly. That's what I was saying before. So, Rich, one of the things Tim and I don't know that we enjoy doing it, but one of the things we do like when we have a CEO on, and we just talked about it with Arnold Donald of Carnival Corporation, like, are you thinking recession? And he talked about his industry being recession resistant. They operate around the world, and everything's a little bit different whether you're over in Europe or here. But I do wonder, when you hear that word come out of someone's mouth, and I do think about Jay Powell, and you include this in your story, a quote by Alan Blinder, who said, the chairman of the Fed doesn't want to let the R word slip out of his mouth in a positive way, that we need a recession. right? But we're going to be parsing everything he says. It's like, wait, did he mean that? Like a recession has to happen? So how do you see it?
Yeah, I mean, part of what is going to be in the dot plot. If the dot plot shows growth slowing down a lot and more importantly unemployment going up, that they're going to be coming perilously close to basically saying we need a recession, because every time the unemployment rate goes up about a half point, it means we're in a recession. So but with 2 job openings for every unemployed person, it's hard to see how they cool off the labor market, how they cool off the economy without getting unemployment out. I mean, at least that's according to a lot of economists. There was a survey out from the Financial Times and the University of Chicago of academic economists today. Nearly 70% of them see a recession next year. So, it's pretty grim out there. And obviously what's happening in the markets today, it doesn't help things because, people look at their 401ks and say, "Oh my gosh, I'm not going to go out and spend on that vacation to Italy."
Right. There's the psychology of watching the portfolio.
Or the wealth effect.
Or I'll do it, right? But I won't buy that new couch, and I'm not going to buy new clothes. Right? You're going to make a trade-off. Right.
Exactly. And obviously, with the gas prices high, especially lower income people are having to make trade-offs already, basically. But the upper income folks may make trade-offs based on how their 401k is looking.
Hey, Rich, speaking of the markets, we have 2 hot headlines here that I want to get to. The Treasury 3-year yield advancing extends to 30 basis points on the day. So we're seeing a rise at the front end there. And then the Fed swap price 4% terminal rate by mid-2023. It's related to the next question I wanted to ask you. What should Fed Chair Jay Powell's goal be in terms of getting inflation down? And how does that how could that prevent the U.S. from going into recession? Let's say if he doesn't push inflation down to 2% and instead pushes it down to 3% or 4%, could that help with a soft landing?
I mean, that could help with a soft landing, and some economists think that that's what he do, like Ethan Harris of Bank of America, think that, they'll say good enough for government work, right? We got it down to 3, we're going to hang out there, and, if we get a recession eventually, that'll push us down to 2. But that's risky because, that kind of laissez-faire type attitude is what got us into a problem in the 1970s when, we didn't kind of eradicate inflation. And I have another economist in the story, Peter Hooper from Deutsche Bank, saying, that would be a Burnsian mistake to sort of say we're not getting back down to 2% because you undercut your credibility and you say, people say, okay, today you're saying it's 3, tomorrow it's going to be 4. You potentially open the Pandora's box to people thinking, it's going to be continually ratcheting.
Rich,
higher.
really quickly, 15 seconds. So is this the most important Fed meeting of the year?
Well, we're only halfway through, but I think for sure this is the most important thing. This is the Volcker moment potentially for Powell.
All right. So glad we could check in with you. Rich Miller, he's an economics reporter at Bloomberg News from D.C. This is Bloomberg.
Broadcasting live from the Bloomberg Interactive Broker Studio in New York. Bloomberg 1130 to Washington, D.C. Bloomberg 99.1 to Boston. Bloomberg 106.1 to San Francisco. Bloomberg 960 to the country. Sirius XM Channel 119. And around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Business Week.
All right, you are listening to Bloomberg Business Week. Carol Massar along with Tim Stenovic here on Bloomberg Radio. So we've talked about the overall economy and, you know, the tough place that Fed Chief Jay Powell is in. And part of that tough place is thanks to higher oil prices and energy prices.
Unfortunately,
right?
a big part of that place is due to that. The question a lot of people have, Carol, is how long are high energy prices going to last? And unfortunately, Javier Blas, who's energy and commodities columnist for Bloomberg Opinion, he's got some news that's not so great.
So
we're going to get to that in just a minute.
It's going to stick around for a while? Is that what you're saying?
Yeah, that's what he's saying.
Yeah.
Yeah, so, all right, more pain at the pump and when you're flying, too. Let's get over to Doug Krisner, though, for an update as we're less than a half hour away from the close. Hey, Doug.
Hey, Tim. So about 28 minutes to go. The equity market is at session lows right now as we make our way to the closing bell, with the Dow down 2.9%. The S&P is off about 3.9%. The NASDAQ composite off nearly 4.7%. So much, if you look at the broader market, much of the decline is being led by energy. Consumer discretionary is also weak, but I think this is pretty much a Tesla story. The stock in Tesla is down by 7.3%. We have indications that Elon Musk told employees that Tesla had a very tough quarter as it's been struggling with a lot of supply chain issues. In an internal memo, Musk went on really to implore workers to get the EV maker back on track. We're also seeing a move up in rates across the U.S. curve. Essentially, what the market is betting on is a much more aggressive Fed. We've got a Fed meeting this week. Foregone conclusion, we're going to get a half-point rate hike. I think that's pretty much baked in. There is this debate, though, is whether or not there could be a 75 basis point rate hike. The Wall Street Journal saying a couple of moments ago, Fed officials could approve a 75 basis point rate hike. 10-year Treasury now at 3.43%. We're up more than 27 basis points. Look at the 2-year, 3.40%, up 34 basis points. I'm Doug Krisner. That's your Bloomberg Business Flash.
Doug, to be real, they could go up 2% if they wanted, right? They can do whatever
anything
the
they
heck
want.
they want, right?
The question is, would you really disarm the market? You can't really. Shock and awe, I don't think is going to work.
Don't you remember when the Fed used to shock and awe us and just there'd be a surprise move in the morning?
Yep.
And they don't really do that. They're very careful about, telegraphing everything. All right, Doug Krisner, thank you so much. So watching macro, big issues, and of course a Fed meeting, but we're also keeping an eye on oil. I mean, WTI crude is backing off a little bit, but we're still above 120 a barrel. We know what's going on. I keep thinking about when are we going to see demand destruction and also concerns about the economy kind of playing into the energy markets, or if and when we will.
Fortunately, we've got with us Javier Blas. He's energy and commodities columnist for Bloomberg Opinion. He knows a ton about energy. In fact, he's written a book about it. He joins us this afternoon, and this evening, I should say, on the phone from London. Javier, good to have you with us. I think the part that might come to the dismay of many who read your most recent column is that there's no end in sight for the price spike. Take us through why there's no end in sight, because it has less to do with demand and much to do with supply.
Yeah, the main problem at the moment is the supply side. We have lost a lot of barrels from Russia, in part because of the European embargo, which is going to take a few months to come in effect, but it's already starting to bite. We have lost also supplies from Libya and from a number of other countries. And the demand is not really that strong, but it's strong enough. There is a lot of pent-up demand from post-COVID, particularly in the West, in Europe, in North America, people who want to travel. But yes, we are complaining about prices. I found myself going to the gas station this weekend. I was traveling around. I was not happy with the cost of filling up the tank, but still I drove around because, we have not had the chance to do that much in Europe after all these 2 years and a half of COVID. So that combination of very tight supply and both on crude and also on refined products and still very strong or relatively strong demand is what is keeping the prices around $120, $121.5 for Brent, despite a broader sell-off in equities. It's quite remarkable how strong the oil market was today, despite what's happening on the broader equity market.
Hey, one of the things I love, Javier, about your reporting is that you've seen so much, but you also you kind of show us how the energy sausage is made, right? Or you remind us. And, you talk specifically about the refining sector and how that's a problem, that we've run out of spare capacity to turn crude into usable fuels. Like, there can be tons of crude out there, but unless you refine it, so what, right?
Yeah, no one really uses crude oil other than if you are a refiner or perhaps you are a power station. So what we need is gasoline, we need diesel, gas oil, we need jet fuel. And the main problem is that the combination of COVID, when the demand collapsed, and also concerns about peak oil demand because of climate change, et cetera, has led to a lot of closures of refining capacity in the West, particularly Europe and again North America. Last year, the last couple of years, we lost the most refining capacity in the West in 30 years. And now the problem is that we have hit the wall of refining capacity, and the result is that prices for refined products are much higher than the price of crude. The refining margin, so the amount of money that a refiner makes from processing crude into fuels like gasoline and diesel, has gone from an average over the last 25 years around $10 a barrel, $10 to $15 a barrel, to as much as $60 a barrel recently. And that's one reason why we are seeing so high prices at the pump.
Well, and it's interesting. I think about our Alex Steele talking with the Chevron CEO, Mike Wirth, who says there may never be another refinery built in the United States. I mean, Javier, one of the reasons Tim and I do like to reach out to you is that, we need to acknowledge, right, as a world, that we are shifting in terms of how we will fuel society, global society going forward. It's a slow shift, but it's aggressively picking up momentum because of the war in Ukraine.
Yeah, and it's going to be a really bumpy shift. It's not easy to shift a global economy that was consuming 100 million barrels a day of refined products into one that is going to move into clean products and running electric vehicles. We have problems producing all those electric vehicles. We were just listening the troubles that Tesla have on the last quarter. And just to shift this huge global economy towards clean products is going to be difficult. It's going to be bumpy. And we have seen some of that trouble that it has been now amplified by the war in Ukraine, by the fact that we are imposing sanctions on Russia. The transition was sold as it was going to be almost a blue sky transition, going into cleaner and cheaper energy sources. It's proven to be a lot more difficult. It's proven to be that, yes, we're moving towards cleaner sources of energy, but it's not going to be as cheap as we thought. And one reminder, despite the fact that we are trying to transition, demand for fossil fuels in 2022 is likely to be at a record high. Oil is very likely to hit an all-time high around July, August. Natural gas consumption has already hit an all-time high. I'm afraid also that coal, the dirtiest of all the fossil fuels, the demand for coal is the highest we have ever seen.
Okay, sounds pretty rough. Listen, love getting an update from you, as always. Javier Blas, energy and commodities columnist at Bloomberg, and of course, author of The World for Sale, Money, Power, and the Traders Who Barter the Earth's Resources.
Let's get to Washington, D.C. now for a check of the latest world and national news with Nancy Lyons. Hey, Nance.
Thanks, Tim. Today's public testimony for the House committee investigating the attack on the Capitol focused on former President Trump's false claims of election fraud. The panel used depositions from within the Trump campaign, including former Attorney General Bill Barr. Barr said as much as he tried to tell Trump there was no credible evidence of election fraud, he believed the former president had his mind already made up.
I felt that before the election, it was possible to talk sense to the president. And while you sometimes had to engage in, a big wrestling match with him, that it was possible to keep things on track. But I felt that after the election, he didn't seem to be listening.
Barr later resigned in December. The panel says Trump's falsehoods are what provoked a mob of his supporters to attack the Capitol. Well, the current Attorney General, Merrick Garland, was asked today if he's been watching the hearings.
I am watching, and I will be watching all the hearings, although I may not be able to watch all of it live.
Garland says the prosecutors handling Capitol riot cases are also watching. A bipartisan group of senators is looking for support of a tentative deal they reached this weekend on a new gun safety measure following last month's massacres in Texas and New York. The package includes giving grants to states to implement red flag laws, allowing courts to remove guns from potentially dangerous owners. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries.
All right, Nance, thank you so much. Nancy Lyons in our DC newsroom. So, folks, we just want to stay on the markets for you because we are seeing, a fair amount of selling continuing in today's session. We're just off are hovering pretty much around our lows here. Actually, I think we're pretty much right now at our lows. Down 4% on the S&P, Dow down 3%, and the NASDAQ down, Tim, about 4.7%. A little perspective, though. Markets go up, markets go down, but it does feel like we're increasingly seeing maybe not total capitulation, but a lot of investors just bailing out of everything.
Yeah, that's absolutely right, Carol. I'm checking out right now. We're at the lowest level on the S&P 500 since January 29th, 2021. So we've essentially gone back in time, given up all the gains of more than the last year. It's the biggest decline, not since May 18th of 2022, which wasn't that long ago, actually, but that's when the S&P 500 fell 4.04%. So we're almost going past that. It's interesting. You had the idea of looking at the most read on the Bloomberg terminal right now in the last hour or so. 9 of the 10 stories, all about the market sell-off that we're seeing. There is one story in there that's not, and it's about what's going on in Washington, D.C., especially with President Trump, or former President Trump, I should say.
Oh, yeah. Are you talking about raising millions?
Yeah.
Yeah, exactly. What's interesting is we talked about traders bracing for a Fed 4% terminal rate as yields keep soaring. I mean, what's been remarkable, we are focusing on certainly the equity trade. We do that a lot. But, you take a look at the moves that we have seen, particularly in the fixed income markets on Friday and today. That is remarkable. Some really big moves in terms of yields shooting up and the flattening of the yield curve.
Yeah, our Markets Live blog pointing out that the bond market sell-off that we're seeing is the worst since the Lehman collapse. And then also, Carol, among the most read has to do with the Fed and the Wall Street Journal story just a few minutes ago that the Fed could approve a 75 basis point rate hike at this meeting.
Yeah, we'll see if that happens. I agree with Doug. Doug Krisner was talking about it, that the Fed does not want to surprise. They like to spoon feed, and so that markets certainly price a lot of stuff in, and we will see whether or not they surprise us or they go real aggressive. You're listening to Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
When you think about the Fed's mission of tightening financial conditions, everything we're seeing in markets today is consistent with that goal. A rout in equities, or at least lower equity prices, a move up in rates across the curve, and a much, much stronger dollar. Today, the bet is that we're going to see much more aggressive Fed tightening, essentially a continuation of the heavy selling that we saw last Friday, which, of course, was precipitated by that very hot reading on U.S. retail inflation. Now, I think it's fair to say that a half-point rate hike is baked in for this week's meeting. There is some debate, though, as to whether or not we could see a surprise, maybe 75 basis point hike. Wall Street Journal reporting this afternoon some Fed officials could approve a 75 basis point hike. The S&P 500 is down 4% right now. We've got the Dow weaker by 3%, and in the NASDAQ market, the composite index is off 4.7%. You're seeing yields up across the curve. At the longer end, the 10-year Treasury at 3.38%, up by more than 22 basis points. At the short end, the 2-year Treasury at 3.33%, a gain of 27 basis points. And I mentioned dollar strength earlier. The Bloomberg Dollar Spot Index right now up by more than 1%. Weakness, though, in the price of Bitcoin as the crypto lender Celsius froze all withdrawals, swaps, and transfers on its platform. Bitcoin right now down about 15% at 23,277. I'm Doug Krisner. That is your Bloomberg Business Flash.
Thank you so much for that update, Doug Krisner. It's 3:49 on Wall Street.
The following is an editorial from Bloomberg Opinion.
This editorial was written by the Bloomberg editorial board. Russia's attack on Ukraine has made the West, in this context NATO and the European Union, more united than it's been in a long time. Unfortunately, as the invasion turns into a grinding war of attrition, that cohesion is now at risk. Western leaders must focus on the two weakest links in their alliance, Turkey and Hungary. Both countries have signaled for weeks that they are not fully behind the effort to support Ukraine. This is no time for unreliable allies. Unfortunately, neither the EU nor NATO has a mechanism to eject errant members. That means both institutions will need to get creative, using economic, diplomatic, and political pressure to bring Hungary and Turkey in line. Holding together the Western alliance has never been easy, but with a worsening war on its doorstep, it has perhaps never been more necessary. This editorial was written by the Bloomberg editorial board. For more Bloomberg Opinion, please go to Bloomberg.com/opinion or OPIN Go on the Bloomberg terminal.
This has been Bloomberg Opinion.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's
the question that drives us.
This is the Drive to the Close
That funky music will drive us till the dawn.
on Bloomberg Radio.
All right, well, no doubt about it. It's a risk-off trade here. We are seeing really no place to hide in this selling, and we are seeing, as Doug mentioned, we're pretty much seeing some selling into the close here and really moving, Tim, to our worst levels of the session.
Yeah, the biggest move in the S&P 500 since June 11th of 2020. We're still at our lowest point since January 29th of 2021. Eager to hear what Mark Travis has to think about it. He's president and CEO of Intrepid Capital. He joins us on the phone from Jacksonville, Florida. Mark, I'd ask you how you're doing right now, but I think we're all just glued to our terminal screens right now. What is the Fed to do? They see the market reaction to the inflation report. They see the concerns that investors have about inflation, the concerns that consumers have about inflation. What are they thinking right now?
They're thinking they should have moved last May, Tim.
Should have, would have, could have, right?
So true.
Yeah, you know, to me, the Fed really doesn't set the market; they respond to it. You saw this in the fourth quarter of 2018 when they were trying to bring down their balance sheet, and the markets, equity markets, threw a tantrum, and they reversed course over the course of in 2019. You know, we've gone from expecting 50 basis points to now people even talking about maybe a surprise 100 2 days from now. You know, they're in an untenable position from my perspective, but I think we've, just like I was thinking back before the call,
I'm old enough to remember portfolio insurance and how well that did in the '87 crash.
Wow.
I now think we can be disabused of modern monetary theory, MMT. I think that's gone the way of the dodo bird too with this move in inflation.
Well, and I do wonder, what is, Mark, the kind of rethink in terms of how investors have been investing over the last decade, right? Where you kind of almost throw money at anything, and certainly index funds, right? Like just kept going higher and higher and higher. So is there some kind of rethink, or is this again, do we need to be smart and understand we're going through a recalibration coming off a pandemic where the economy was shut down, the market sold off very quickly. We got a ton of stimulus that propped everything up again. And now we're trying to figure out, okay, what is reality post-pandemic?
Well, Carol, I think you really go back to the great financial crisis. I think we've had unbelievable amounts of stimulus since, the fall of '08, early '09, and it's really just rolled through to now, the summer of '22. Index funds work great, but really about 5 equity securities work great that pulled the index along. And now, when we had over that last 10 or 12 years an investment hurdle with, unbelievably low cost of capital in the low single digits, anything looked like a good investment. Well, now that the discount rate on all those very, very distant cash flows are being repriced, it's painful for, long duration assets, wherever they may be. Where I'm empathetic is for the kind of retail investor that's been forced into the capital markets by rate suppression activity. 10, 15 years ago, that retiree was comfortable in a 4 or 5%, FDIC insured CD, and then first they were kind of pushed into the bond market, and when those rates went, investment grade rates went below the S&P dividend, they came into the equity markets, and now that's kind of unraveling for them. So, I have a sticker I keep on the back of my door, and I pull it out on days like today, and it says, chaos creates opportunity. I do believe that, and I think there are opportunities, but in the equity market, I really believe you've got to have probably a 5-year time horizon.
Right.
If you're putting money to work in the equity market in June of 22 for your property tax bill in November, I would want to discourage you from that.
Yeah.
Mark, speaking of opportunity, I want to go through some of the names that you have. One sticks out to me, True Leaf Cannabis, because we've spoken to Kim Rivers, the company's chair and CEO, quite a bit. Another company that's actually based in Florida like you are. Why are you optimistic on True Leaf?
Well, there are very few licenses in the state of Florida. We actually had an analyst on site for their investor day last week, Tim, and saw their facilities and really impressed. And we've been an equity holder, and it's been a painful ride here in the last year.
Yeah, down 47% so far this year.
Yeah, and trailing 12s, I believe, about 60. So
yeah.
But what you have in some of these multi-state operators, which True Leaf is a dominant one, is you have tremendous growth rates in sales. They trade at very low multiples of pre-tax cash flow, their enterprise value. They have onerous tax burdens, and they're not allowed access to the federal banking system. I think due to the kind of the risk some of these retail facilities present to neighborhoods, because they're basically cash transactions, the True Leaf store close to us, I believe, out of 1,500 square feet, does like $12 million worth of revenue a year. And so I think you're going to see a Safe Banking Act pass at some point. But even though there's a Democratic House, Senate, and executive branch, they can't seem to coalesce behind one bill. Even though there's aptitude on both sides of the aisle to see this happen. At the same time, you're going to see, I think, just full legalization in states like Florida, not just for medical, but also in Arizona. So, they've done well in a very capital-constrained environment due to, kind of onerous tax and banking difficulties. But if you really look at the number of licensed users in Florida, for example, it grows about 1,000 a week, I believe. It's a phenomenal growth rate. And the other thing I would say is most big fund managers are not able to touch the equity of somebody like True Leaf, whereas we are.
Well, there's certainly, like you said, some of these names, though, beaten up, and there's certainly many are saying, as we talked with our Mike Regan, everybody becoming kind of a value play or value investor at this point, because there are certainly a lot of names that are a lot cheaper than they were a year ago or even 6 months ago. Hey, Mark, thank you so much. Mark Travis, co-founder, president, and CEO at the independent advisory firm Intrepid Capital, joining us on the phone from Jacksonville, Florida. Tim, you're going to head out.
I'm heading out, but I will still be with you spiritually, okay?
All right.
Especially with a sell-off like this.
Looking forward to it, yeah. And the sell-off is continuing. I'm just taking a look at the charts right now, and we are pretty much hovering near our lows of this session. All right, time to head over to our TV colleagues for Beyond the Bell, live on radio, TV, and YouTube. We count you down to the close.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
We are about 2 minutes away from the end of the trading day. Caroline Hyde, Taylor Riggs, Gina Martin, Adams in the house for Romain Bostic. Counting you down to the closing bell. Here to take us beyond that bell, a global simulcast. Carol Massa joins us, and we look at extraordinary breadth as we go towards the breadth of our audiences in TV, radio, and YouTube. I look at 36% higher than your usual average trading, Carol, on the day?
Yeah, and right, we always talk about this. We've been watching volumes when we either have an up or down day to see what kind of conviction is behind the trade. Well, a lot of conviction behind this downward trade. We started the day with 504 names in the S&P 500. Every name in the S&P down. Right now, 499 lower, 5 still holding on to gains. But if everything ends down, that would be something that doesn't happen often, guys.
And the big questions that we've gotten from all the strategists today, Gina, I think of Professor Siegel over at Wharton saying this is really the huge discount rate story. I'm taking a look at 2-year yields, seeing the biggest one-day gain that we haven't seen since 2008. 10-year yields, we actually saw these types of big moves back in 2020. The focus has shifted really to the front end of that curve.
Yeah, and it's really is the stock market just absolutely choking on what's happening in the bond market. There's no other fundamental reason why today is such a magic day. It does seem that it kicked off on Friday and then carried on in today, and you see it across sectors, every sector down on the day. Very rare breadth loss today as well. It's the worst day of the year by one measure, and that is the percentage of stocks trading down on the day is more than we've seen so far this year. So really true capitulation starting to become finally evident in the equity market. If there is a silver lining, it's that would indicate we're at least getting closer to bottom.
We are 5 seconds away. We're going to let these numbers settle out. And Caroline, I think we're going to take our time and really breathe here because we're going to get a lot of soups, a lot of headlines really crossing here. But according to my measures, we are seeing the biggest decline in the S&P 500 now since March 23rd of 2020. On that day, that market had fallen more than 11.5%. But indeed today, it is a market that is dropping about 150 points to about 3.9% lower on the S&P 500. A lot of numbers, at least 250 of these really down more than 20% here from some of the record highs that we had on January 3rd of this year. So that is really dragging down the market to the lowest levels that we haven't seen since about January of 2021. What is so interesting, Carol, is the market, the NASDAQ looks worse on the day, about 4.7%, but it actually is really only the worst day that I'm looking at since May of this year. So you've seen tons of volatility within the equity market here, within some of those big tech stocks. And of course, the Russell 2000 really in focus when we think about the small cap, domestic focused economy, the concerns here about some of these recessionary fears that played out here within the small cap stocks today.
A couple of things you said, Taylor, that get my attention. First of all, you talk about volatility. The VIX closing at 34.34, so up about 6.5 points. But although we keep hearing people say, well, 40 is the new 30 when it comes to concerns in terms of volatility and what it says about maybe hitting some market capitulation. You talk about big tech, Microsoft, Meta, Oracle, Intel. These are all among the big tech names that hit 52-week lows today, guys, in the session.
I don't know what's wrong with the VIX, frankly, because it's clear to me that the market is in distress. I mean, the sector performance alone tells you a lot about just how weak and how broad the market weakness has been over the course of today. Intriguingly, energy stocks, some of the worst stocks in the market, which is a very big shift in trend relative to where we've been all year. The energy stocks leading the way. Finally, some signs of capitulation there. Utilities and real estate stocks also among the weakest stocks in the market. Those are typically more stable, lower beta segments. I just look at the losers. The list of losers tends to be concentrated in year-to-date relative winners, which is a very big signal to follow into tomorrow.
Yeah, I think the energy, I agree with you, is certainly an interesting trade here. And you do wonder what that says about concerns about the economy, and to see that market, which has been such an outperformer. Hey, when it came to decliners, man, there were so many to choose from on this Monday trade. I'm going to take you to Tesla because I thought it was an interesting company story, down about 7% in today's session, following on a 3% decline come Friday. Musk warning of Tesla's very tough quarter and an internal employee message, so putting that out. Also want to mention Netflix. It was down about 7.25%. Even news that Squid Game will return for a second season was not enough to interest investors, so that name was down. As for gainers, very few out there, and I had to actually change it around as stocks went from green to red in today's session. CME Group is your top gainer in the S&P 500. There was an interesting story just talking about the money it makes in interest rate contracts and also energy contracts, so maybe that is why there's some optimism in thinking about that name. And then I had to go to the Russell to really find some outperformance, 126% higher in today's session. We're talking about day one biopharmaceuticals. Ticker is Dawn, and this is a biotech cancer company surging following some initial data from a pediatric brain tumor trial that a Piper Sandler analyst said exceeds expectations. So that really was some outperformance, guys.
Meanwhile, let's just take a moment to survey the damage that has been felt cross-asset. For our radio audience, I'm looking at global macro movers. There is only one area of green on this screen, and it is the US dollar index, currently up more than a percentage point, really the haven of choice on a day such as this, when you see in other currency pairs the fall felt hardest in some of these more emerging market-related or indeed commodity-focused, global growth-focused kind of commodity pairs. So Australian dollar was weakening to the tune of almost 2%, similar moves to the Kiwi over in New Zealand, the British pound weakening by 1.5% against the US dollar, really no place other than the US dollar, and sensitively at one point the Japanese yen, but really the dollar, the haven of choice on FX. And that's as we look across the commodities, again, a sea of red. We saw tiny 0.2% higher on oil, for example, as we see once again that being the trade and in that being the inflationary pressure. We see instead the rest of the commodity spectrum reflecting that global growth worry that we now have. Can we see the after effects of a Federal Reserve and central banks worldwide having to hike in the face of price inflation, meaning global growth does indeed fall? We look to see the likes of natural gas coming down here in the United States, steel prices off by 0.9%, iron ore off by 0.6%. We really saw metals and soft commodities fall in large part because of that strength of that US dollar, and a global sovereign bond picture that speaks to the yields pushing ever higher as we question where hawkish tones come from worldwide. Looking in Asia, 23 basis point move on a 2-year Singapore debt. We see in Europe, Switzerland up 22 basis point, Portuguese debt 27 basis points on your 2-year, but of course mega moves in the US Treasury market as well, Taylor.
Mega, Caroline, on the day, and I just want to put this in perspective. In the last 6 days, the 2-year yield has jumped 68 basis points. If that just doesn't catch your attention, I don't know what does. On the day, of course, a lot of that move came today. We just climbed 27 basis points. It's effectively like a Fed rate hike in one day. It's really sort of when we're really focused here on the front end of that yield curve, though, of course, every other portion of the yield curve climbed at least 18 basis points or so, 18, 20, 22, but really the bigger moves really on the front end. And Gina, talk to us about sort of the impact that this has had finally, maybe on the equity markets, as maybe we're finally realizing the understanding of higher discount rates and the impact on present value.
Yeah, I think we've been working into finding out, what the impact of higher rates is on present value for equities all year with the valuation compression we've seen so far. But now you've got 20% of stocks in the index trading with a single-digit multiple. So that's 20% of stocks in the S&P 500 trading below 10 times forward earnings. This is a type of valuation multiple or breadth decline in valuations that you typically don't see except for in periods of major distress. So we are starting to see this priced in. When you look further out, though, the bond market is sending a somewhat worrisome signal because the 2-year Treasury 2 years from now, those futures markets are anticipating that we'll see a 2-year Treasury yield of 3.65.
So
these are numbers we haven't seen in a long time in the equity market.
How much of this could be overdone? You know, Neil Dutta of Renaissance Macro saying, we think it's a problem that Fed is moving off their previous guidance and what was not a large surprise in the data. And he's just, you know, it's a lagging economic indicator. Like, you do wonder at this point, how much did maybe that journal story, maybe they got it wrong, maybe it's, you know, we're overreaction in terms of the markets.
Let's go back to fundamentals for a moment, because the Oracle numbers are coming out. Shares climbing post-market, so some reprieve for that particular name. Oracle fourth quarter adjusted revenue, $11.84 billion. The estimate had been for 11.66. They're overall seeing an operating margin coming in actually slightly better than expected at 47%, and the operating income coming in at $5.59 billion. The market had been looking for 5.4, so a relatively healthy beat, whether or not we'd already seen some of those earning estimates pulled lower. But this is also for their fiscal full year, remember, and we are seeing a company that had moved itself to Texas overall. Cloud services and license support revenues up 3% in US dollar. Constant currencies, they were up 7%. So interesting take in terms of this impact of the US dollar, the strength of it, of course, that already Microsoft had been signaling would be an issue. But they do see overall total revenues for 2022 up 5% in US dollar terms, up 7% in constant currencies, Taylor.
And this is where Gina might have a nice time to weigh in here, because I think, look, operating cash flow, $10 billion in the trailing 12 months. If this is a company that can get it done, it's Apple, it's Oracle. And yet, Carol, the market's saying, yeah, no, I don't think so. I mean, maybe in the aftermarket for Oracle, yes, but sort of long term, the market is saying, no, not enough. You still have a higher discount rate.
Yeah, I think that is a really important point, because this is not necessarily about fundamental earnings growth nor the economy. It's about what's happening in the rates market. And the stock market sort of being whipped around by what's happening in the rates market is the story of 2022 to us. We see very clear divergence between low duration stocks and high duration stocks in the equity market. It's the single most dominant factor of performance. That in and of itself tells you that this is a market that's all about what's happening in rates and trying to price the path for Fed tightening and the broader rates landscape.
Yeah, it's a really good point. We got to reset, certainly in terms of rate expectations, and now you wonder when it goes back to a reset based on fundamentals. And so that's kind of what we're seeing in the markets. All right, guys, that's going to do it. We're going to wrap up our cross-platform coverage, radio, TV, and YouTube beyond the bell. We will see you again, same time, same place, tomorrow.
This is Bloomberg Business Week with Carol Masser and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
All right, you are listening to Bloomberg Business Week. Carol Masser here in our Interactive Brokers studio, streaming on YouTube. So wrapping up what we saw in terms of the trade, and great to have with us Jess Minton, who follows the markets for us here at Bloomberg. So, you know, I always think what's smart is we need to take a step back and kind of, I feel like we can understand why we saw the trade we saw today, right?
Right. And obviously just another day where there's been a sea of red. And this is a day that a lot of strategists has told me that they first saw coming, just because when looking at the breadth and momentum, we had seen some improvements recently, but not enough to where they had conviction that that would have been a sustainable rally in recent weeks. And so I've talked to you in the past, in recent weeks, about how we sort of went through this progression in, say, early 2021, where we saw a peak in mid-cap and small-cap stocks. And then we saw sort of this consolidation, but then the larger cap indexes still churning higher and hitting those records, and then obviously the NASDAQ and the NASDAQ 100 peaking in November, and then obviously the S&P 500. And we saw just these tech and growth indexes just get hammered this year, and still the S&P 500 relatively held up well, but now today actually crossing that 20% threshold. But when you talk to strategists, as far as trying to say today, oh, we're now officially in a bear market, they're saying we've seen this coming for 15 months almost, as far as when they're looking at the progression. But if you're sort of the average trader or just a retail investor, that doesn't seem like something that you would normally, if you're kind of looking beneath the surface, you're not seeing all those momentum indicators there. So that's something that's been kind of interesting to me, depending on who I'm talking about, because some people will say, well, you know, we've already been in a bear market for months. So even though we've kind of gone by that textbook definition of 20%, to them, they're thinking, okay, now we're finally there, even though they first saw some of that already happening.
Just one thing, we're talking with Bloomberg News equities reporter Jess Minton here in our Interactive Brokers studio on Bloomberg Business Week. Just how much, though, is a reaction to an aggressive Fed who's thinking about reining in inflation, overdoing it, recession, and what does that mean ultimately for growth and corporate earnings going forward, versus versus at this point, versus something else, right? Like, I feel like it's very, like, we understand why this is happening.
Right. And especially because of those dynamics with what's going on with the Federal Reserve, but not even just the Fed. It's a huge central bank week when you're looking at the Bank of Japan and also the Bank of England coming off the back of last week with the ECB completely changing course and now getting more aggressive. And so
But Bank of Japan isn't.
Right. And so that's the big thing on Friday once we hear from them as far as because what's going on with their economy. Do they change their tune at all? It doesn't seem likely, but that's the concern of whether or not will they surprise and somehow try to reverse course. But obviously they have their challenges with that economy. But the bigger thing is just the speed in which we've seen yields move much higher.
To me, that's the interesting
big
story,
thing.
right? And I think about how traders essentially are thinking, okay, the Fed's going to be a lot more aggressive, and they're going to be much more aggressive, much more quickly.
Yes, and especially just the speed in which the 10-year Treasury topping 3.1%, but then you're looking at the 2-year note as well, and just how stocks have to recalibrate so much faster based on that, and especially just growth and technology stocks.
What is that recalibration? Because is it based on that the slowing of the economy, and so valuations don't make sense? Like, explain that connection, which we always talk about in particular when it comes to the big tech or high growth names.
So it has to do with their future earnings growth, and then they just looking at those valuations, they still look too pricey in general. And it's interesting too, just looking at how when people want to say whether stocks were oversold or not, if you look at the 14-day relative strength index, the only time it fell below 30 this year was in late January. So even
Are you talking about for tech or S&P?
For just overall with the S&P 500. And so then you can kind of broaden that out too for different sectors. And so that kind of paints the picture of kind of surprising to a lot of people because all of the different days we've seen, especially in the past month, and especially just overall with the S&P 500 being down 9 of the last 10 weeks, the fact that the last time it was actually oversold was late January, and that sell-off that went in ahead of whenever Russia invaded Ukraine in late February, that's kind of surprising to a lot of people. But with the tech story and the growth story, again, when you see that huge move in yields, it's really going to pressure those stocks. But today, again, there weren't a lot of places to hide. Really, one of the few stocks that were up was McDonald's, barely higher, in CME.
I stayed away. I had it as a gainer. First of all, I had Smucker's, which was a gainer. Then it turned lower, and then
Coca-Cola briefly higher, but then just slightly lower. And for actually something that was interesting, the S&P 500 was flirting with the most broad-based decline in more than a decade. So at one point today, all 405 members of the S&P 500 were lower. Yes, and so that would have been the first time since 2011, which obviously was the year where there were concerns about the U.S.'s credit rating and obviously the aftermath of the financial crisis going on and issues going on with Europe and the debt crisis over there. So that was kind of the situation in 2011. But today we actually did not meet that threshold. There's still a couple of stocks that ended up higher, but it just shows you just how broad-based the selling.
5 in the S&P 500. Right. Well, what's interesting too, and forgive me, folks, I mean, maybe because we've seen a fair amount of market cycles, the selling felt pretty nasty. We know it was broad-based. We saw some volume too on the downside. But markets worked, right? We didn't see any kind of triggers go into effect, correct? Like, it was orderly.
Right. No sort of circuit breakers going off, nothing like that we would have been reminiscent of what we would have seen, say, in March of 2020. And so you and I have talked a lot about capitulation and technicians trying to figure out whether we're close to the bottom. So one promising sign today, just looking overall at breadth, just 5% of stocks were trading above their 50-day moving average. So typically since the great financial crisis, usually when the S&P 500 has fallen at least 15%, you see that happen. But the other caveat to that would be when I was talking about the relative strength index, you want to see that fall below 30.
The RSI.
The RSI, we haven't seen that quite yet. So that's another caveat to that. But again, also looking at the VIX.
And we see it a lot. If I look, take it back, as you said, I think go back to January, a lot of times it gets close, but it doesn't go below that 30 mark.
It bounces around that 30 mark. And then the VIX, it's always kind of a head scratcher being around 33, 34. You'd think a day like today, you'd see that spike.
Gina was like, I don't know what's going on. Gina Martin Adams, like, I don't know what's going on with the VIX today. But there was I'm trying to think, one of the voices that our team talked to in the morning that was talking about the VIX 40 is the new 30 in terms of watching when it's kind of a key number.
Right. That definitely has been sort of the theme there during the spring. And bringing up Gina, another big indicator. So tomorrow we get PPI. Sometimes it doesn't get as much love in these sort of inflation gauge kind of space, but Gina's team had pointed out how S&P 500 margins remain vulnerable whenever there's a widening gap between producer prices and consumer price inflation. So kind of looking at what's been happening with margin pressures, that'll be interesting to see what that report says tomorrow morning. And again, we have that Federal Reserve decision Wednesday afternoon. So there's still another indicator there that they're going to be keeping a close eye on.
I want to say it was Evercore ISI strategist Julian Emanuel said we didn't envision 3 days of carnage in the markets. What's been missing the last several months is sort of what I would call a cathartic flush out where you get the VIX above 40, which is one of the things you need for at least a trading bottom. And that's why he was talking about it, 40 being the new 30. Thank you so much. A great market rundown. Jess Menton joining us here in our Bloomberg Interactive Brokers studio. All right, let's get back to Doug Krisner watching the markets and the close. He joins us now with the Bloomberg Business News Flash. Hey, Doug.
Hey, Carol. So I'm looking at shares in Oracle right now in the late U.S. session. Stock is up by more than 8.5%. That's after Oracle, after the bell, reported fourth quarter adjusted revenue and earnings per share, both of which were above estimates. That said, it was a day of heavy selling for the equity market right through the close. S&P 500 very near the worst level of the day with a loss of about 3.9%. A lot of this centers on the expectation that we're going to see much more aggressive Fed tightening. We've got the Fed meeting this week. Conventional wisdom is it's a half-point increase. Fed funds will go up by 50 basis points. Although today, curiously, the Wall Street Journal was saying Fed officials could approve a 75 basis point rate hike. Even before that story hit the wire, we had yields across the curve at elevated levels. A real spike on the 10-year, up by more than 21 basis points to 3.36%. At the shorter end, the 2-year jumped 27 basis points to 3.33%. In terms of the equity market price action, the Dow today down 2.8%. Mentioned the weakness in the S&P, weaker by about 3.9%, and the NASDAQ comp down 4.7% today. But look at the dollar. The Bloomberg Dollar Spot Index rallying by 1.1%. I'm Doug Krisner. That is your Bloomberg Business Flash.
Yeah, that's going to be tough when companies report their overseas earnings results. All right, Doug, thank you so much. Well, all month long, we're focusing on equality in the workplace. And joining us is Gianni Biscontini, founder of Work Well, the employee well-being agency. She's a board-certified behavior analyst, and she's author of a new provocative title and book, which we won't completely say on air, but it is about a guide to wild, unencumbered freedoms for women. And as I read in for this segment, she is all about challenging women to overcome harmful narratives and fight for their rights. She does join us on the phone in San Diego. Gianna, nice to have you here with us. Tell us about, I feel like we've been having so many conversations for decades at this point about women in the workplace. How do we need to think about it differently so that we move the needle more significantly?
Well, first of all, thank you so much for having me. I'm excited to be here with you today. And yeah, you're exactly right. We've been having these conversations for decades. We've been doing this research on gender and leadership and equality in business for decades. And sometimes it takes a lot of variables to hit the right spot before it's really that tipping point. And I think now it is that tipping point with where we are as a society, in a political climate, with our environment. We are seeing employees, especially after the pandemic, start to really demand more feminine leadership, more empathy, more compassion, listening skills, that type of thing. And so I think this is really a movement that's hitting its tipping point right now to get more females in leadership and out being vocal in business.
All right, but what's the role? Okay, and we always talk about women helping other women, right? And it's not just about mentorship, it's sponsorship, creating that pipeline, really moving other women along. But men have a role in all of this. In fact, I would say they have a pretty significant role in making this work because they tend to be in more leadership roles at more companies.
Absolutely. And I will say for my book, which is, it has pink flames on the cover and a woman on the cover.
Don't say the title, otherwise we're all going to get in trouble. Please.
No, I won't. I'm used to that by now. But I would say, for a very feminine looking book, about 30 to 40% of sales have been to men. And so when I talk to men about why they're buying the book, first of all, I'm thrilled. And I've gotten so many messages from men saying, thank you for writing this book, not only because they can use it themselves to be more authentic and kind of shirt the gender norms that exist for all of us in society, but I get messages saying, I know I can be a better husband. I know I can be a better boss to my female employees. I don't have their perspective. I've never been a woman in the workforce. And so they're really showing up in droves to not only look at the research, but to read books like mine and to reach out to women like me to ask questions. And I think that is the most important part.
Gianna, I don't know. You know, there's tons of books written about kind of women in the workplace. And I think about Sheryl Sandberg. We've talked a lot about her in the last couple of weeks as she has stepped away from Meta, but, about leaning in. And then it's, there's been times where people are like, women, you got to act more like men. And then when you do, there's repercussions. Like, is there some consensus about how women can truly achieve in the workplace? Or as long as they have children, will it never really be equal because they are looked at differently?
I think it's twofold. First of all, we need to stop trying to fix women and to tell them that the way to get ahead is to act more like men. More of the same isn't going to help now these days. When you look at the research on innovation, creativity, problem solving, diversity, how we're going to move ahead as a society and in business, we need diversity in thought. We need diversity in gender and in race and ethnicity across the board. And so more of the same isn't really going to advance us at all. And I do make the point in the book to say, look, this isn't about smashing a patriarchy, right? It doesn't mean that those things aren't in place, but this work takes all of us because, as we see, men are still primarily the ones who are hiring and in leadership positions. And so it does really take a perspective change as a whole and discussions, real honest discussions about gender and our experiences to agree to how we can all move forward.
I love what you said about real discussion. So what is a real discussion versus kind of the discussions that we've been having in the corporate environment that really don't move the needle?
Well, the quote unquote, air quotes, discussions that we've been having are very, to me, swimming in the shallow end. That does nothing for people to get vulnerable and empathetic and to share their experiences, which is really where we connect with each other and feel safe enough to have those deeper and deeper conversations. And so it really takes a ton of open-mindedness and vulnerability, which unfortunately is not the norm in business these days. We still have this very tacky 90s corporate version of professionalism where we all have to wear up showing, wearing the same suit and saying the same thing and using the same rhetoric. And that's just not going to get us ahead. And so I would really encourage companies to sit down and say, look, what are we doing? How authentic are we being? How value aligned are we being? And how vulnerable are we being while still remaining professional? Because this is going to be a big change and requires this direction completely.
Just got about 30 seconds left here. A piece of advice for the men in the world.
Ask questions. I think through no fault of their own, we condition men to not question themselves. And so they end up going out into the world, they have to have all the answers or that they do have all the answers. And it's okay not to. Like I said, most of the men have never been a woman in business. And so what I see successful across every industry is men sitting down, getting comfortable and asking questions that might highlight their lack of competence or understanding, but also opens the door for women to speak. We can't simply say, women speak up. That's not how it works.
All right, gonna leave it there. Really enjoyed this. Thank you so much. Good luck with your work, and hopefully we can talk again. Gianna Bisconti, she is founder of WorkWell, joining us on the phone from San Diego. You're listening to Bloomberg Business Week. Carol Masser in our Interactive Broker studio, and this is Bloomberg Radio.
Broadcasting live from the Bloomberg Interactive Broker Studio in New York. Bloomberg 1130 to Washington, D.C. Bloomberg 99.1 to Boston. Bloomberg 106.1 to San Francisco. Bloomberg 960 to the country. Sirius XM Channel 119. And around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Business Week.
You are listening to Bloomberg Business Week. I'm Carol Masser in our Bloomberg Interactive Brokers studio at Bloomberg headquarters in New York City. Yep, a rough one for the markets. We're going to do a little bit more of a deep dive into it and the trade today, and rightfully so. In the meantime, let's get up to speed on some of the news after the close. Here is once again Doug Krisner.
Hey, Carol, let's begin with Oracle. After the bell, the company announced fourth quarter adjusted revenue and EPS. Both metrics were above what the market was expecting, and shares in Oracle right now in the late session higher by more than 8.5%. But you're absolutely right, Carol. It was a tough day for the equity market. We tumbled right at the open and seemed to never look back. We finished just off the worst level of the day. So really what's going on here is the bet for a lot more aggression in terms of Fed tightening. We've got a meeting on Wednesday. Foregone conclusion is that the Fed is going to raise rates by 50 basis points, although now many on the street are having a conversation around a 75-point rate hike. Today, the Wall Street Journal is saying the Fed could approve a rate hike of that magnitude. If you look at the equity market price action, we had the Dow today down about 2.8%, the S&P down 3.9%, NASDAQ composite is off about 4.7%. Yields across the curve spiking today, 10-year Treasury at 3.37%, up nearly 22 basis points, a 2-year at 3.38 with a gain of more than 31 basis points. The dollar, clearly the big beneficiary of that spike in rates. The Bloomberg Dollar Spot Index rising 1.1% today. I'm Doug Krisner. That's your Bloomberg Business Flash.
It is indeed. All right, Doug, thank you so much. All right, we're going to stay with the markets. Doug doing this great breakdown of the trade today. Let's head back to our Michael Regan, Bloomberg Markets Senior Editor here at Bloomberg. We talked to him earlier about, hey, everybody, you're now a value investor. And I feel like names that were normally growth names are now value names, perhaps.
Yeah.
Mike, you know, I do appreciate when someone who's seen a lot of market cycles, and I really do, because, you know, we need to understand markets go up, markets go down, and there are fundamental reasons why they do it, or sometimes it's technical reasons. But after a day like today, where we saw some extra volume, what does it say to you?
Well, looking for that volume is key. I think what a lot of people are sort of waiting for is what's known as capitulation, that sort of really nasty one-day drop.
And when it happens, right, a big sign goes up in Times Square that the market's capitulation.
We'll see if we can have that arranged for the next time. But
it's nuanced, right?
Well,
or is it?
You know, it's the type of thing where if this were sort of a routine humdrum 10% correction in a market that doesn't have a lot of fundamental problems, but maybe just got ahead of its skis as far as momentum on the upside.
Right.
This would be the type of day where people would be like, boy, this sure looks like capitulation. But as Doug mentioned, we came off of those lows of the day. That's actually not what you want to see in you know, as ironic as it sounds. Normally that would be...
You want like off a cliff, right?
That's what a lot of people are waiting for. As crazy as it sounds, they want to see just that a complete exhaustion of sellers. And you know, again, in some market cycles, this would a day like this would surely look like it. But look, we've seen so many nasty days like this.
Right.
This is only the worst drop in the S&P 500 since like the middle of May, in less than a month.
That's what I said to you when you came in before we started. I'm like, what's wrong with me? Like, I'm not all stressed out. And I said, well, maybe I haven't looked at my 401k in a little while, and maybe that's why. But I do feel like, Taylor Riggs was saying it earlier, like in a year that's been full of superlatives, I don't know what finally kind of, rattles everybody.
Yeah. Well, I think people are rattled, but we're now at the lowest since January of 2021. So this is a historic sell-off. But it's really, it's hard to sort of wrap your head around what could basically signal that bottom that a lot of people are looking for, because, we do have this very big problem with inflation and rising interest rates from the Federal Reserve. And we've got a few more days now until we'll actually get clarity from the Fed. We're in that blackout period. It was a tough month for that CPI number to hit on Friday, because the previous month it came out and the Fed meeting wasn't the following week, so there were instantly some Fed members out giving interviews saying, what they thought about the path of interest rates. And they sort of walked back investors from the notion of a 75 basis point increase. Now, no one, has the Fed to sort of tell them if that's a possibility this time. There's talk of even a full percentage point increase at the next meeting. I think that's a pretty highly unlikely. I think Jerome Powell has made it clear that 50 basis points is probably what we're going to see this week. But no one knows, given how high that CPI 8.6% was on Friday.
I want to throw in, because Neil Dutt over at Renaissance Macro, he was on air with us, following that hot CPI print. But he messaged me today, and he's like, I hope, Neil, you're okay with me sharing this. We do think it's a problem that the Fed is moving off their previous guidance in what was not a large surprise in the data, one that moved in the direction they expected, and that we are talking about a lagging economic indicator, inflation. What's the Fed's off-ramp to 75? So, you know what I mean? Like, it's not like that number was a complete surprise.
Right.
It just, everybody thought we were going to be at peak, or would have maybe gone down more.
Right. Well, but the flip side of it is, not only are people looking for capitulation in the equity market, they're kind of looking for some capitulation from the Fed in that I feel like a lot of people wish they would just rip the Band-Aid off.
Like, Jay Powell, I screwed up. All right, we're all in on a 75 basis points.
75 or even a full percentage point.
Right.
Let's get this tightening campaign over with.
So that Volcker moment, as Rich Miller said earlier.
Right. And it's not quite clear that we're going to get that either. I think it's highly doubtful that we will, to be honest. So that's just kind of prolonging the mystery here to some degree.
So this, like, often ahead of a Fed meeting, like, markets just kind of mark time. Any thoughts on what happens potentially tomorrow in the trade, or what you might anticipate might happen? Or if we get a lot more selling again ahead of that Wednesday meeting, like, what might it mean?
It wouldn't surprise me to see a little bit of a rebound, at least in the morning tomorrow, just because this was, while, again, maybe not that total capitulation that we're expecting, and ultimately not the lowest point we'll see in the stock market. It's just such an ugly day, and we've had 3 straight days of just really relentless selling that it wouldn't be too surprising for people to say, okay, now we're looking at an S&P where the forward P price to earnings ratio is below 16, and that's kind of a level that it hadn't seen a lot previous.
Low, right?
It's in recent history, it's very low. So you might find some people coming in and maybe buying this dip. That's not to say that that's it. That this is the end of it, and it's back to.
So when we have a headline, a red sticky as we call it here at Bloomberg, that the S&P 500 closed down 22% from that record high. So it did technically enter this bear market, on a close here. It doesn't mean it couldn't go down 25% or 30%, correct?
Right, absolutely. And it's actually kind of rare for bear markets to stop at the low 20s. They usually do go into the 30s or something like that. The last time the selling ended a month or two ago was when we hit that 20% figure right on the nose, and it was clear enough traders were there saying, let's buy it here.
Yeah.
This isn't a bear market really, but now that idea has been blown to shreds like everything else.
Yeah, exactly. All right, Mike Regan, thanks for doing a 2-shot hit for us here on Bloomberg Business Week. Michael Regan, our Bloomberg Markets senior editor. All right, back to World and National News and Nancy Lyons. Hey, Nance.
Thanks, Carol. The House committee investigating the January 6th insurrection heard from former advisors that they told President Trump his claims of election fraud did not bear up, but he persisted anyway.
Campaign manager Bill Stepien told the president absentee ballots would take days to impact the final count.
My recommendation was to say that votes were still being counted. It's too early to tell.
Ivanka Trump told her father much the same.
The results were still being counted. The race would not be called on election night.
Political pros on his staff, including Eric Hirschman, told him concerning the fraud claims.
What they were proposing, I thought was nuts.
Trump preferred to follow the advice of Rudy Giuliani and claim victory on election night, when advisor Jason Miller said Giuliani was inebriated. In Washington, Irv Chapman, Bloomberg Radio.
Attorney General Merrick Garland says he's been watching the House hearings, but he would not elaborate on any possible investigation into former President Trump.
We are proceeding with full urgency with respect, as I've said many times before, to hold all perpetrators who are criminally responsible for January 6th accountable, regardless of their level, their position, and regardless of whether they were present at the events of January 6th.
Garland says the department continues its work identifying the rioters. Global news, 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons. This is Bloomberg.
All right, Nance, thank you so much. Carol Masser in our Bloomberg Interactive Broker Studio, and Doug Krisner, host of Bloomberg Daybreak Asia and covering for Charlie Pellet for the last week or so. Doug, you've seen a lot of market cycles. I have to say, you know what I find interesting is after all this selling, Oracle comes out, and this stock is up 9% in the after hours. I would have thought on such a kind of downward day that investors would have just blown it off.
It's kind of interesting because I think you made an interesting point earlier, Carol, when you described the kind of orderly nature of today's selling. I don't think we're at a point now, or I'm not sensing it, where there's kind of real panic setting in. And I think that we really have to focus more on what's happening in the Treasury market, too, because that's where yields have been spiking over the last couple of days now. I mean, if you look at the 10-year at 3.36%, we're up more than 21 basis points today alone. We had a similar move on Friday of last week with that hot CPI data. So it's essentially what the Fed is trying to create, right? Tighter financial conditions. So you're going to assume that we're going to see lower stock prices. You're going to assume that we're going to see higher rates across the curve. You're going to assume that the dollar is going to be a lot stronger. I don't think the Fed is going to be dissuaded from proceeding to tighten based on anything that we're seeing today.
Yeah, but 50, 75, 1, you know, one thing that Jay Powell has done is he's very good about, laying it out for investors so that there aren't those surprises. You and I talked about, I remember, like, you wake up and the Fed had done something really early. That just doesn't happen anymore unless it's in a crisis.
You're right. I think, though, that the bigger issue is the rate of change, and I think that the market probably can stomach this, given what we have been talking about, just in terms of the way bond market has kind of repriced
connection lost.
Expects Fed policy will be. So I don't even think if we get a 75 basis point that would destabilize anything. I mean, you probably would find a pocket of the market that would welcome that.
Right, like done. Rip the Band-Aid off and
absolutely.
we're done. But I do think about consumer sentiment, that Michigan number on Friday, a record low, and I do wonder how that's going to play out.
That correlates to the inflation story, right?
Yep.
Inflation expectations are very high right now.
All right, well, there you have it. The markets in just about 2 minutes' time. Doug Krisner, you're the best. You're listening to Bloomberg Business Week, and this is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
We had a sell-off in the equity market, similar story to what we had last Friday with that very hot reading on consumer-level inflation in the U.S. Today, yields spiked across the curve. We had a 10-year Treasury last quoted up 20 basis points at 3.35%, a 2-year at 3.36 with a gain of nearly 30 basis points on the day. We've got the Fed meeting this week. Conventional wisdom is that we're going to get a half-point rate hike, although now some on the street, many on the street, are discussing the possibility of a 75 basis point rate hike. The Wall Street Journal is saying today, yep, Fed officials could approve a 75 basis point increase. So now if you look at the S&P 500, we are down more than 20% from that January record. So by that measure, bear market. S&P today weaker by 3.9%, Dow Industrial Average off 2.8%, and the NASDAQ Composite tumbling by 4.7% today. Then, after the bell, Oracle with fourth quarter adjusted revenue and EPS, both metrics above forecast. The stock right now, if you can believe it, is higher by 8.8%. Back to the move up in yields, one of the reasons that the dollar is as strong as it is, the Bloomberg Dollar Spot Index today jumping by more than 1%. I'm Doug Krisner, and that is your Bloomberg Business Flash.
Doug, we are living in interesting times, that's for sure. All right, Doug Krisner, thank you so much. Full day, dense market day, as Doug just revealed, with risk-off trade front and center. We're counting down to that Fed decision come Wednesday, so we thought you might appreciate a little bit of a breather. We're going to check in with a company that's thinking a lot about the future, how we grow food, something that is likely to be trickier as we continue to populate Earth while climate change makes it more difficult to feed everyone and produce. So back with us, Julia Collins, founder and CEO of Planet Forward. It's a company which says it's making climate-friendly snacks made from regenerative ingredients. She's here to give us an update. She joins us via Zoom in San Francisco. Julia, how are you? Julia, can you hear us? A little bit of a frozen. We'll see if we can work that out technically and get her with us. In the meantime, just a little reminder of that news from Oracle after the close. I do find it fascinating that the stock is up about 9% in the after hours. It did report after the closing bell. This is a stock you're going to see play out in tomorrow's trade. Oracle, of course, jumping after revenue tops estimates on strong cloud efforts. So certainly one of those key tech names to keep an eye on. All right, I think we've worked out the tech snafus. Julia Collins is founder and CEO of Planet Forward. She is with us via Zoom in San Francisco. Hey, Julia, it's been a while, I think December of 2020, that you last joined us. How are you? Tell us what's been going on in the last couple of years.
Hi, Carol. It's so good to reconnect with you. And, you know, so much has changed in our world, but the one thing that certainly remains the same is the urgency of addressing climate change. You know, we have fewer than 100 months to reduce global emissions by 40%. And so that is why I'm actually really excited to be building and scaling solutions to help get the job done.
So remind our audience, Julia, for those who might not remember, like what you guys are doing specifically, and give us an idea of kind of the growth you're seeing and you know, the reality of your business.
Yeah, you know, it's often surprising for people to learn that 60% of global emissions, 60% come from household use. Things like groceries, clothing, personal care. 60% of all of the emissions that we generate as a population come from household use. And so what we do at Planet Forward is to think of ways to help the companies that are creating all of those products to decarbonize, to get from where they are to zero. So we work with food, beverage, fashion, and beauty companies to help them measure their emissions, reduce them, and then get them on a path to being carbon neutral toward net zero goals.
Well, it's a really good point that you said, and I know I kind of stressed the food element of it because there is so much extreme food waste. It's amazing, ironic to me in a really sad way that we have people starving around the world, and yet there's so much food waste, and that food waste leads to climate change. It's amazing. You guys are doing things directly, but you do work with other companies. What is involved in the process? Help educate our audience in terms of regenerative ingredients. What's involved, and is it a lot more expensive at a time when we're looking at the cost of things very closely?
This is true. You know, the most important thing that any organization can do is to first understand where you stand. You need to establish a baseline. And this is true when you're measuring anything, right? But when it comes to your environmental impact, the first thing that you have to do is to do an assessment. And so we're helping brands across all categories of consumer, from food to fashion, beauty, and everything in between, to first understand their current footprint. And we do that using a very unique set of data that we've been developing over a 15-year period, as well as some very nuanced value chain models that help people to understand the impact of decisions that they make. You talked a little bit about regenerative agriculture, right? This is a term that's trending, and it's a very exciting place to see a lot of interest and investment. The importance of regenerative agriculture as it relates to climate change is that regenerative agriculture is a way of managing agricultural systems that helps them to improve the health of those systems. And in doing so, can also trap and sequester atmospheric carbon. We call that carbon sequestration. And so one of the things that's exciting as we think about the future of food is a shift to more of these climate-friendly agronomy practices, including regenerative agriculture. And so that's just one of the levers that we have to help companies to reduce.
But how tough is it to do, as you know, Julia, in a system that's already, I talk about this a lot, whether it's our energy system, but the infrastructure that is so entrenched. Same thing for our food system, right? I used to work a lot with Chipotle, years ago, and they were trying to, rework the food chain. It's not so easy because it's kind of set in its ways, and I think there are changes happening. So, can we produce everything from my shoes to my clothes to the meal I'm going to eat tonight to my studio and what it's all made of? Can we do it in a way that truly is better for the environment, based on what you are seeing?
Yeah, based on what I'm seeing, we absolutely can. We can decarbonize every aspect of our economy.
But is it more expensive? Is it hard? Why is the process to some extent seemingly slow?
To date, there's been a combination of sort of lack of awareness, which I think is changing, right? Particularly coming out of the last IPCC. There's been somewhat of a lack of an aligned framework, and we're seeing some of that changing with new regulation. We saw the first glimpse at the SEC's climate rule coming down in March, the first glimpse of it. We're seeing state level regulation, like in California, requiring companies to disclose their emissions. So that's changing. And we're also seeing consumers catch up. 82% of millennials and Gen Z are saying that they want their companies to stand up for climate change. So there's just more market dynamics in favor of taking action now than there ever have been. And that's why, Carol, I really believe that the job will happen. It'll get done. In terms of it being more expensive, there are some changes. For example, the cost of renewable energy is going down, and that is fantastic news for companies that are looking to reduce emissions, because often changing to renewable energy in your manufacturing operations is one of the best ways to reduce emissions.
Well, fun to talk with you, and I hope we can continue the conversation more frequently, because it is so relevant to our world today. And I know with the conversations we have with CEOs, we talked with Arnold Donald earlier, they have been certainly working in terms of sustainability initiatives, certainly for their company, but you're seeing this conversation pervasive in all industries. Julia, thank you so much. Julia Collins, she's founder and CEO of Planet Forward, joining us via Zoom from San Francisco. So you heard it earlier, stocks entering a bear market officially. We're talking about the S&P 500. We saw Treasury yields spike to levels we haven't seen in a decade, and really the dollar taking off, rallying. Hot inflation, that print on Friday, really stressing out and rattling global trading. And of course, we have that Fed meeting on Wednesday. Our coverage will continue, of course, tomorrow. Coming up next, though, we're talking politics. This is Bloomberg.